my game of what I've decided to play here. And he says in the book, more than I want big returns, I want to be financially unbreakable. And I would maybe add there and the ability to make decisions. So my game is to be financially unbreakable, to have enough where I can overcome obstacles, downturns, hard things with the family, medical things, like whatever it is, financially unbreakable.
Welcome to the Military Money Manual podcast, where every episode is all about achieving financial independence in the military faster than before. We believe personal finance shouldn't be boring or intimidating. Building wealth can be simple, and financial freedom is the ultimate financial goal. Now, here's your hosts, Spencer and Jamie.
Hello, podcast listeners. Jamie here, and I'm with my co-host, Spencer Reese, founder of the militarymoneymanual.com and author of the book, The Military Money Manual. Thanks for joining us today, as we're going to be talking about one of the best recent finance books, and one you've heard us talk about several times before, called The Psychology of Money by Morgan Housel.
Hey, Jamie. Thanks. Yeah, I like this book so much that I actually wrapped up my own book with a quote from The Psychology of Money by Morgan Housel. I first listened to the audiobook, I think it was in 2020 or 2021 during the pandemic, which I thought was excellent. The audiobook is really well done, really well read. And you can get that on Audible or wherever you get your audiobooks. And then I recently reread the Kindle version. And I was surprised, which I shouldn't have been because the audiobook is pretty short too, but the actual Kindle version is really quick. I mean, and the chapters are really nice and succinct, and you can kind of digest, one or two chapters in a 10 or 20 minute period, which is great. And then on the Kindle, you can go and put your highlights on it. So I really enjoy reading books on the Kindle now, which is something that is new for me. But yeah, Morgan's written a really great short book. Like I said, broken into 20 chapters, and each chapter covers a different idea or motif that he's observed on money and investing. So he's written a lot about money and personal finance and investing, and he's kind of consolidated everything that he's observed over the years into the book. And I think he's done a really great job with it. 3 takeaways from the book for military service members or military spouses, military families listening to the podcast today. Number 1, save money for no reason at all, or for any reason. But building a margin of safety into your financial life is the surest way to not get wiped out and be forced to start over. Saved money buys you freedom. And he has this great quote. Let me see if I can find it here. Save. Just save. You don't need a specific reason to save. It's great to save for a car or a down payment or a medical emergency, but saving for things that are impossible to predict or define is one of the best reasons to save. And we'll get into some of the details on that point there, but man, he's got some great quotes from this book, so I'm excited to share them. Number 2, play your own game. No one is crazy, but some people do stupid things with their money. So it's important to figure out your own game and then play that game and not get distracted by the games other people are playing. And then number 3, the third main point for today, there's a quote. I couldn't actually figure out who said it first based on a quick Google, but instead of don't just stand there, do something, they reverse it and say, don't just do something, stand there. And what they mean by that is usually the correct move in investing is to do the same thing, whether you're in a bull market or a bear market. Just aim to be reasonable and don't worry too much about being rational. Just set a plan and then stick with it. And if your plan doesn't account for bear markets or for down markets, you probably need a different plan. But if it does account for that kind of plan, like the plan that I advocate in my book, simple, low cost, automated, and diversified investing in passive index funds, that kind of plan, we know that there's going to be depressions. We know that there's going to be recessions, and that's all built into it. If you look at the rate of return of the U.S. stock market over the last 100 years, and you just think about all the history and all the terrible things that have happened over the last 100 years and all the good things that have happened, and it all averages out. And if you bail on the market, if you pull your investments to cash when things are going bad, you would never invest because there's always a reason to not invest.
One of my favorite things about this book is that it approaches finances from such a different perspective from other personal finance books. In Morgan's background, he was a writer for Motley Fool, and I think he's been, investment banks and venture capital, like that kind of stuff, from what I remember. But he takes this from a different standpoint of thinking about the behaviors and not just the math. So we like to talk about, I know we've said, and there's kind of a movement in the financial independence, retire earlier, the FIRE community right now, to think about and sit and talk about how it's more than just math and there's behavior involved in finances. But I think he kind of started that movement with this book, and the momentum that of talking about that and starting that discussion is kind of caught on and is very positive. And one of the things that he says in the introduction is that we're taught about money in ways that are much like physics, with rules and laws, but not enough of it is thought of like psychology, with emotions and nuances. And a lot of it, he says, and I agree with, is just luck. The wherever you're born, you said this, I think, an episode or two ago, Spencer, of like wherever you were born, when you were born, whether you're born during the Great Depression or during the longest bull run in the history of the US stock market, like a lot of it is just luck. So don't always think about it as if you're amazing just because you made one good decision, or you're terrible because you made one bad decision. And he says a lot of it is just luck of the timing. So I really like his focus on behavior here. A lot of it is luck, and not so much as like a hard science of do this, this, and this, and you'll be wealthy.
Yeah, he really just, kind of lays out, here's what I've observed about how people make financial decisions. And then here's what I'm doing with my own money. But he never, and he might give some prescriptions of, I think that for most people, a passive index fund investing strategy is going to be the one that works. But he also makes it very clear that, hey, you might be a day trader and that might be your full-time job, is to trade stocks. I don't know who you are, right? So if that's your job, then your financial situation is going to look completely different from, a young service member who's trying to pay off their car loan and is putting
Yeah.
5% into their ESP. He starts in the introduction with this great quote: "Ordinary folks with no financial education can be wealthy if they have a handful of behavioral skills that have nothing to do with formal measures of intelligence." And then he
Mm.
goes into these two great stories, and he compares and contrasts two individuals. One is Ronald James Reed. He was a multimillionaire gas station attendant and janitor, and he ended up, I'm not going to ruin the whole story, but he ends up donating millions of dollars after his death, and never worked a job making, more than $50,000 a year or whatever. And people are like, where did all this money come from? And surprise, surprise, it was just long-term investing and compounding interest. And
Yeah.
he compares Ronald to Richard, I'm going to mess up this name, Fusconi, who is the former vice chairman of Merrill Lynch. And Merrill Lynch is a $600 billion assets under management investment firm.
Gee.
And Richard ended up going broke during the global financial crisis because he was over leveraged. He had borrowed too much and he was living right to the limit of his income. And when it slowed down and when interest rates went up, he couldn't afford his lifestyle anymore. And he ended up declaring bankruptcy, and they ended up selling his house. And he was, I think he was like Harvard MBA or like Wharton Business School. I mean, like top education, right? And what Morgan has done is he just says, like, look, like you can be Richard and be the most, educated, financially savvy individual, one of the most financially savvy individuals in the world, who has access to, millions of dollars of leverage and the smartest people in the room. And you can still screw it all up if
Hmm.
your behavior isn't financially optimal. And
Yeah.
or you can be a Ronald and you can just apply some simple rules, and given enough time and given enough, compounding interest, you'll end up a millionaire eventually. All right, so let's keep going here. We'll start with our main point number one, and then we'll get into a couple other just sub points of other topics that I like how Morgan addresses them. So um, in the book that I wrote, the Military Money Manual, I give a lot of examples of why you'd want to save money, and I share some of my personal stories. Right after my wife and I got married, she was driving around in our 2002 Saturn L300, went over a speed bump a little fast, and cracked the oil pan, and and we had to take it into the shop, and it was like a $500 repair. But at the time, we had a couple $1,000s in our emergency fund. So while it stung and it wasn't fun, it was pretty easy to cover, that expense. But and so I talk about a few other examples in my book, and there's all kinds of bad things that can happen. But Morgan takes this really interesting approach, and he says, "Yeah, sure, you can think of all these scenarios, but at the end of the day, just saving to save and to buy yourself options essentially is why you should save. Like, don't, yes, you could save for emergencies, or yes, you can save for certain purchases, but just save in general. And if you think about it, it makes complete sense. I mean, if you're not saving anything, right? You're spending 100% of your paycheck, you are living in a very precarious situation. If you have any kind of unexpected expense pop up, or if have any kind of just any kind of unexpected expense
Yeah.
pop up, if you're living paycheck to paycheck, then you're going to be in a world of hurt, and you're going to have to either dip into savings, but we just established you don't have any, and so you're probably going to have to take on some kind of debt,
Debt.
and now you're going to be in an even more precarious situation. So I shared that one quote from the book earlier, but here's the other one that I have here. Some people save money for a down payment on a house or a new car or retirement. That's great, of course, but saving does not require a goal of purchasing something specific. You can save just for saving's sake. And indeed, you should. Everyone should. End quote.
I love how he talks about having a margin of safety or room for error, he calls it in chapter 5, because he says it's the most or one of the most underappreciated forces in finance is having a margin of safety. And I feel like I can really agree with this in my life, and I think a lot of people feel less stress in life, or especially with their finances, which often leads to less stress in their life overall when they have a little bit of a buffer. We've talked before in our financial independence episodes about how building wealth, financial independence, and long-term investments give you options, that FU money, and he has a whole chapter about freedom and just having the ability to make choices. And in fact, he says that, let me see if I can find the exact quote, that controlling your time is the highest dividend money pays. And I think that is a great kind of summary of the save money. And even if you don't have a specific goal, just saving money is going to give you options. And one day the option might be, do I keep my job or not? Do I take this assignment that I'm going to make less money because I'm not getting, combat pay as much, or I'm not going TDY as much? Or does the spouse become a stay-at-home parent so they can homeschool for a couple years because the schools are really bad here? You don't know a year ago, no, 3 years ago, no one knew COVID was coming, right? No one knew it a month before. So, well, okay, maybe before January. We knew it in January, but you don't know what's coming next month or next year. So sometimes just saving will give you that room to make good decisions when the time comes.
Yeah, he also has a chapter called "You'll Change," and it just talks about how the person who you are today is not the same person you're going to be in tomorrow or in a
Yeah.
year or 10 years. And so long-term planning and like setting yourself up, or creating a lifestyle for yourself today and not taking into account your future self is foolish, because your future self is going to have different priorities and be a different person than you are. So, one thing I talk about in my book is you're not just saving for present you, you're saving for future you too. And so if you can take a little bit of your income and set it aside and send it to your future self, and thanks to the magic of compounding interest and a rising stock market over the long period of time, and assets that grow in value and produce income, you can send more money than you currently have to your future self. And I
Mhm.
know, like, there's so many times when I check my portfolio, or check my TSP balance, right? And there's hundreds of thousands of dollars in there. And I think, like, sometimes I'm like, where did all that money come from? Because I kind of remember putting money in there, right? But
It was so automatic that you didn't.
it was so automated.
Yeah.
It came right out of my paycheck. It wasn't like I was writing a check every day. And that, I think, is, yeah, just one of those like powerful ideas that he has in the book about just saving to save, and saving because when you have money set aside, that represents freedom. And for us in the military, we can't just quit our job tomorrow. But one day you're not going to be in the military anymore, whether that's separation, whether that's retirement. And then you're going to have a civilian job if you want it. Uh, and then you can quit for most of those jobs. But even in the military, you have terms of enlistment or terms of, I can't remember what the officer term is, but appointment. Are you
Separation.
appointed? Are you appointed as an officer? And
You have
so
you have times where you can choose to get out or not. I know what you
exactly.
mean. Yeah, yeah,
Yeah. And so at the end of your service commitments, then, if you have savings, it opens up options for you. And if you don't have savings, then it limits your options because
yeah,
sure, you can still get out. But if you get out with $100,000, $250,000 saved, it's going to feel a lot more comfortable than if you get out with just the leave that you can sell back a few
yeah.
$10,000. And that's the situation a lot of people find themselves in. But if you had if you set up the automated system years ago, if you could go back in time and tell your past self, hey, please just set aside a little bit, whether it's 5% or 10% of your paycheck, then it's amazing how fast it grows.
He talks a lot, Spencer, about when to know if you have enough, and um, I don't know if this is jumping ahead too not, but too much or not, but he talks about preventing the goalpost from moving and knowing that it's enough. So he says, savings can be created by spending less, and you can spend less if you desire less. So how can we desire less? We've talked about um, our our brain's adaptation to continuously want more. What advice do you have for that?
Yeah, I mean that's a classic. You'll see it on some websites or some podcasts as hedonic adaptation or the hedonic treadmill. And essentially, what it is you have a baseline level of happiness, and when you acquire more things or even more experiences, for that matter, but as you just acquire more of life, you just become used to it. You become inured to it. That becomes your new baseline. And so, what can a few things that you can do. I mean, there's there's a great course called The Science of Happiness. I
Signs
think
of happiness. Yeah,
is taught. It's taught at Yale. Yeah, and they have these rewirements basically where they have these tasks where they want you to perform, daily or weekly or whatever it is for a couple days or a couple weeks. And essentially, you're tricking your brain into just noticing your situation. And it can be as simple as like every time you go get a glass of water, just think about how many people in the world, and it's over 700 million, I think, last time I checked, how many people in the world can't just get clean, fresh water daily. And I'm not even talking
yeah,
about like water in their home. I'm talking about just like full stop. They can't get access to clean, fresh water. And it's millions, it's hundreds of millions. And that's insane when you think about it, that here we are in 2021 and we're on the iPhone, whatever, 13, 14
13
and there's still
for now.
yeah, but there's still people in the world who don't have access to clean drinking water, and some of them probably have
Mhm.
iPhone 13s. But
Yeah,
that's the insane, the insane thing about our world and about our economy is that you have access to all of these different things, and yet some people, don't even have access to clean drinking water. And so it's just a lot of it is just recognizing how good you have it. If you're listening to this podcast right now, you probably have it pretty good.
yeah.
And recognizing that, whether it's through journaling or just taking a break and noticing your situation or um, there's a lot of talk about like gratitude journals and just like, hey, just like every day, take 2 minutes in the morning and jot down like three things that you're thankful for, or like one person you're thankful for, one thing you're thankful for, and then one activity you're thankful for.
Yeah.
And just doing that, your brain, it tricks your brain basically into like recognizing like, oh, like I have it pretty good. And a lot of what drives people to when they think they don't have it that good, they try to fill that void with more things and more experiences and more people and more money. And Morgan talks about in his book, like there's this, centimillionaire, worth over $100 million. and he's on this conference call during the 2008 global financial crisis. And he hears that Warren Buffett is about to buy $5 billion of Goldman Sachs stock. And he hangs up the phone, calls his stockbroker. 16 seconds later, his stockbroker buys, 175,000 shares of Goldman Sachs before the news is public, right? So both of them just committed all kinds of insider
Insider
trading,
trading, yeah.
SEC violations, and they got caught. And it was like the easiest case the SEC ever had to prosecute, right? And guess what? He went to jail and he had to pay millions of dollars in fine. This is a guy who was worth $100 million. And you know how much he made off that trade? He made $1 million. But guess what? He ended up losing his freedom, his reputation, lots of his money. I don't know if his family still, stayed with his wife and kids, but I mean, that's a real risk you run there. And it just shows that even people who, I don't know anybody with $100 million, but I can imagine that if you had $100 million, there's a lot of things that you can do that people with $100 or a mere $1 million can't do. And yet they're still just as messed up as everybody else. They still have the same problems and they're still on the hedonic treadmill. They're still
Yeah.
looking for that next thing and they're trying to fill that void. And you can't do it with money. It has to come from somewhere else, whether it's, relationships, whether it's religion, philosophy, it's got to come from somewhere else. And having that idea of enough, it's not going to come from money, because you can always get more money. There's always, he talks about in the book about how, like, I think was it baseball players, and how, like, they start out making like $500,000 a year, which sounds great, right? But then they're comparing themselves to the guy who's making like $30 million a year. And he's comparing himself to the hedge fund managers who are making $300 million a year. And they're comparing themselves to Jeff Bezos, who made like $40 billion during the pandemic. So,
Next week
there's
on
always,
on Amazon Prime Day, he's gonna make another billion probably.
exactly. So there's always,
He
a bigger fish.
he talks a lot about ego in the book and how that affects our decisions. Basically, a lot of our desire for more things is just trying to boost our ego, kind of like you were saying a minute ago. And kind of get back to the savings. Another thing you mentioned is, like, when you're saving, you don't have to be saving for a house or a boat. Like, don't save for any of those. He says, I'm saving for a world where curveballs are more common than we expect, because in everything he's learned about personal finance, everyone without exception will eventually face a huge expense they did not expect, and they don't plan for these expenses specifically because they did not expect them. So that's where that savings without a specific goal, giving yourself a margin of error or like a safety buffer, however you want to think of it, is so powerful.
Yeah. And I think, like, when you're saving on the road to financial independence, it's easy to think, okay, this money is like, this is for my FI, this is for my retirement. I can never touch this money. But money is fungible. Money can be moved from accounts to accounts. And sometimes you don't want to touch it because it's in, a retirement account, and there's going to be penalties if you take it out. But for Roth IRAs, you can take any contribution out of a Roth IRA immediately and put it to whatever purpose you want. Now, should you do that? Probably not. But again, it's about being, Morgan talks about this, it's about being reasonable and not rational. So if you have finally found, you just got out of the military, you've got a great job, you find a good house, you got a good mortgage rate, and you need a little bit of money for a down payment, if you need to take that out of your Roth IRA so you can get into this home, and you're going to end up living in this home for 10, 20, or 30 years, do it. It's not, he has this great quote about you're not a spreadsheet, like, did you find that one? Let me
Yeah,
see that. Oh
you're
yeah.
not a spreadsheet, you're a person, a screwed up emotional person. It took me a while
Yep.
to figure this out, but once it clicked, I realized it's one of the most important parts of finance. Don't
Yeah.
aim to
And
be
there it
coldly
is.
rational. Yeah.
Yeah. Don't aim to be coldly rational. Like, we, you and me, Jamie, we love our spreadsheets, right? But
Mhm.
at the end of the day, if it came down to choosing between your family and the spreadsheet, you would gladly give up the spreadsheet for, well, most of your spreadsheets. I'm sure there's some that, but
I don't know, right now
there's
my
so much.
six-year-old could probably
Yeah, yeah, you trade her in.
she's pretty difficult these days.
Yeah. But yeah, I mean, it's there are curveballs in life, and there's tons of things that I never expected to have to spend money on. But because we were saving and investing for financial independence, you end up having more. You just have, it just buys you flexibility. And when you have money set aside, if there's a you move to a new country and you need to buy a car to get around, you've got the cash there and you can pull it out if you need to, and it's okay.
Yeah.
And maybe it's going to set you back from your financial independence goal by a couple weeks or a couple months, but in the long run, it's going to be okay. Like you are on once you're on the path and once you can kind of see the journey to get there. I mean, if today someone took everything I own away from me, I've as long as I kept all the principles and the ideas that I've built up over the last 34 years of, or probably let's say 15 years of studying personal finance and investing, it's okay. Like I could start over from 34 and I know I'd be financially independent again by 65.
Hmm.
And it's so much of it is just knowing the path that you have to take and then having the patience to stay on that path to get to your goal.
That's good. Speaking of the path you have to take, our second main point, we talked about playing your own game and not what other people are doing. And I think under this one, there's kind of two areas in my mind of not doing something just because everyone else is doing it, like maybe trading crypto or buying a real estate property, or you got to kind of figure out your own path. And the other thing he talks a lot about that kind of falls under this in my mind is social comparison and how the goalposts are always moving, which we kind of hit on a little bit. But what do you think about playing your own game? What are kind of your favorite things from the book that hit point number two?
What seems crazy to you might make sense to me. Your personal experiences with money make up 0.00000000001% of what's happening in the world, but maybe 80% of how you think the world works. So equally smart people can disagree about how and why recessions happen, how you should invest your money, what you should prioritize, how much risk you should take on, and so on, end quote. And to me, one of the best examples of this, and I know my dad listens to the podcast, so hey dad, but we are constantly disagreeing about where the stock market is going in the near term, in the short term, in the long term. And he is always sending me, the doom and gloom newsletters that say like, oh, you think a 20% market drop is bad. Wait till you see what's coming up next. Like better buy your gold, better buy your Bitcoin. And I'm that's not me. I am the eternal optimist. And when I see the stock market down 20%, I think, oh, that's great. Like it's a 20% off sale. Now it sucks because I have a lot of money invested. So, I think this is one of my first 6-figure losses since the COVID crash. But if you don't, go back and listen to our what do you do when the stock market crashes episode? As long as you don't realize the gain, you don't sell, you don't cash out, you hold on to your shares. In the long run, history has shown it's going to be okay. You're going to make your money back. But it just goes to show, like my dad graduated college in the 80s with super high inflation, and stocks weren't a good play at the time. But for me, my entire life, I grew up in the 90s, right? So stocks, you could buy any stock and it was a
Yeah.
good buy. And when I started investing, well, I was in college from 2006 to 2010 studying economics. So what did I study? I mean, I watched in real time the global financial crisis as the entire world economy collapsed around us, and our econ teachers were like, this is nuts, like this is historic, this has never happened
Yeah.
before, like you guys are in a great time. And so when did I start investing? March 2009. Right. So I've had nothing but a huge bull run, a huge tailwind pushing my investments up. And so that's my experience, right? And so again, that makes up a fraction of a percentage of the total, world experience, because I'm only 1 in 7 billion people. And so it's easy for me as, this white male from New England to say, oh yeah, just like buy US stocks. Like they always go up. It's great. And that's how I think the world works. But there's plenty of people, even very similar people to me, like my dad, who they don't think that's how the world works. And he's not crazy, and I'm not crazy. Well, at least we think. But we have very different
No
interpretations.
comment.
Yeah, we have very different
Gotcha.
interpretations on how it all works. So, yeah, I think it's important to getting back to some of the points that we had, but playing your own game, and even though other people, they might it might make sense like what they're saying, and they might be rational, but you have to figure out what game that they're playing before you start copying their actions.
100%. So one example I have is when Robinhood got really popular as the trading app that was kind of like selling the idea of we're gonna like stick it to the man and take it to the big banks, and we're gonna open up trading to the average layperson and get rid of all these fees and these upsells and extra charges, and just anyone can invest in the stock market right on their phone. And so everyone was kind of talking about it at work. And so everyone signs up, like, here's my referral code. You get $5 of Tesla stock if you sign up, and everyone's passing these around. But you don't know what the person next to you, their goal may be to pay off their student loan debt this year. And then the person 2 seats down, their goal may be to save up for a down payment for a house. 3 seats down, they may be trying to save up for financial independence, or one of them's trying to fund their emergency fund because they got a baby coming. So you can't, just because everyone else is doing it, you can't just jump on the Robinhood or the crypto. And I know we've talked about, Spencer, about how both you and I put a very small percentage of our investments in crypto over the last couple of years. Well, now one of the apps that we used from our friend is not even letting us get our money out, right? So thankfully it was a
Yep.
very small percentage, but had we just blindly followed like one of the bros tips, hot stock tips of the day, plenty of people put the majority of their liquid net worth into crypto, and now it's down 70-80%, if not 100%, depending on your coin. But even my Bitcoin and Ethereum is down, I think, like 75-85% from when I bought. So you can't just jump on the bandwagon without understanding what your goals are and what the person that is trying to get you to do it, what their goals are, because the game is just different for each person.
Yeah, and I think even if I mean, eventually, if you understand what game that they are playing, and I think for a lot of people, like, they think they're playing different games, but they're really not, right? Like, what do we all want in the end? Like, everybody wants to be wealthy, right? Like, who wouldn't want to be? Not, maybe there's a couple monks out there that that don't, but for most people listening to this podcast, like, you probably want to be rich, you probably want to be wealthy, and you probably want to have choices and freedom, to make those choices and have enough money that, you work because you want to. And so once you realize that, and you realize that, man, we're all pretty much playing the same game, people are always looking for shortcuts, and people are always looking for ways to get to that goal faster. And, whether it's day trading stocks, whether it's options trading, I know that was really popular during the pandemic. Um, Cryptocurrency. I mean, there's always people who are out there, and a lot of them we used to work with, I feel like, but they, and I think it's in any military unit. There's always somebody who's out there who's, and they're not trying to scam anybody. They're trying to do the right thing, but they think they found a shortcut, and they think they found a way to get to their goal that much faster. So many of them either, maybe they get in at the right time, but do they get out at the right time? And I'm in the same boat where I had just a little bit of crypto because I was dabbling in it, and I knew it that the whole system would collapse, because every time I get in on something,
You're the
it's
bad luck.
the I'm the black swan. The bubble is like, if I
Safe
tell
bet.
you to buy, yeah, if I tell you to buy anything other than VTSAX, run away, because it is it is about to collapse. In fact, funny story, when I was in high school, the US had just invaded Iraq, and as part of that, they issued a new currency. And so
This is a good one.
I
This is a
got
good one.
yeah, and so I got into this, like, I mean, I think, I'm pretty sure it was legal, but basically I was buying Iraqi dinar, this Iraqi currency, on eBay from, like, guys who were over in Iraq, and they were shipping it back to the States. and you'd get like, I don't know, something stupid like you give him like $700 and you get like a million Iraqi dinar because it was trading at like whatever that is, 7.07 cents to the Iraqi dinar. But pre-war, it was $3 to a dinar, right? So they were like, oh, even if it goes back up to parity, like you're gonna make so much money. And of course, nobody made any money. I mean, the Iraqi economy was in shambles. They fought a war in a civil war for like the next 10 years, 15 years. So, and then they had to deal with ISIS. So, yeah, just absolutely like everything I touch, it's like the reverse Midas, everything I touch does not turn to gold. But what it has done is it's reinforced over and over again that there is one game that I'm good at, and that is long-term passive index fund investing. And as long as I stick to that, we're gonna be okay. But if I try to dabble in anything else, good luck.
Yeah, I think that's a great point, and what I was gonna say, is kinda similar because, for you and I, we've decided our game is passive, low-cost index fund investing, and to get to financial independence, so we have the option to work or not work before the average person in Western civilization does. I was talking to someone the other day, and I asked them if they were planning to work for a long time, and they were like, "Yeah, I think so, maybe 60, 65." And I'm just like, "Man, they have no concept of the fact that there are other options." And sometimes when I mention to friends or people at work or someone that like, "Hey, I'm aiming for financial independence by 45," and their mind's blown that that's even an option. So if
Yeah.
someone's playing a completely different game than you and they're trying to find shortcuts, just let it reinforce your decision that you made a year ago or 6 months ago or 5 years ago, whenever you decided that financial independence sounded appealing to you, that you're in it for your goal, and don't let social comparison. Because another great thing from the book is that just because someone has a really nice car, $100,000 Lamborghini or whatever, maybe nice Teslas or whatever you're into these days, like just because you see someone with that car doesn't mean they're better off than you or they're wealthier than you or richer than you. It just means that they spent $100,000 or that they took out a loan for $100,000. There's no So we like to compare ourselves to other people's situations and try to figure out things like that, but it's just the fact that they made a purchase or they took out a loan doesn't mean they're in a better spot than you in any way.
Yeah, he's got one quote here about a measurable percentage of those reading this book will at some point in their life earn a salary or have a sum of money sufficient to cover every reasonable thing they need and a lot of what they want. If you're one of them, remember a few things. The hardest financial skill is getting the goalposts to stop moving. And then he talks
Yeah.
about social comparison. And it's so true, as I reach the end of my military career, um, you know, it is hard as I get closer to financial independence here that you know you start to think, oh, well, what if I just worked for a couple more years? What else? What other toys? What other adventures? What other houses? What else could I add to the lifestyle? It just if you if you start going down that road, it's a slippery slope to mix all the metaphors because, like he says, if you don't stop the goalpost from moving, or at least slow the goalpost down a bit, then they're gonna always gonna be just ahead of you.
Close the second point that with this kind of quote that summarizes my game of what I've decided to play here. And he says in the book, more than I want big returns, I want to be financially unbreakable. And I would maybe add there and the ability to make decisions. So my game is to be financially unbreakable, to have enough where I can overcome obstacles, downturns, hard things with the family, medical things, like whatever it is, financially unbreakable. If you ask 10 of your friends, I would be willing to wager a bet that none of them would use that term as that's the game that they're playing. So remember that you have to play your own game. That leads us into point 3, which is to set a reasonable plan and stick to it.
Yeah, so he talks a lot about, and I mentioned it before, but being reasonable if not completely rational. And the example that he uses is he's paid off his house, and he lives in a completely paid off house. And when he brings this up to his financial buddies, or I mean, he's in the financial ecosystem because he used to write write for Market Watch, and now I think he writes for an investment company. They say, "Oh, that's crazy. Like, why don't you just, a couple of years ago, you
Look at
could
my
borrow."
spreadsheet.
Yeah, exactly. Look at my spreadsheet. You could borrow at 2.5% and invest that money at 7%, and you'd be, multi-million dollar richer when you're, 60. And Morgan just says, "Oh, that's great. I understand. I know the math, but I, to me, having my home completely paid off, no bank can ever come in and say, you've missed a couple
You're out.
payments, you're out. We're foreclosing on the house." And he said, for him, that level of security is worth basically any cost. But the cost is just paying off your mortgage and, you know, foregoing maybe a little bit of future growth if you invested the money. But the other thing is, right, for Morgan, is when he doesn't have a mortgage payment, that's like one less thing in the budget. That just frees up that little bit of cash flow. I mean, for depending
A
on where you live, it
lot.
could be a lot of
Yeah.
cash flow, but it frees up that cash flow so that his lifestyle, when we talk about lifestyle creep or we talk about like financial independence number, if you're 25xing, $40,000 less a year, that's $1 million less that you have to have set aside.
Yeah.
And that gets right back to his point about margin of safety, right? Like when you have flexibility built in to your plan and to I really like what you talk about, Jamie, with having like unbreakable finances, right? Like you could get hit by a car tomorrow. God forbid, someone in your family could have cancer, and you wouldn't be able to work another day in your life, and it's going to be okay, right? Like
Yeah.
you've set it up so that it's going to be okay, and at least from the financial point of view, right? And that's another thing I've been thinking a lot about recently is like a lot of what we're talking about here is just solving the money problem, right? Because everybody, when they come into the world, unless you inherit, I mean, even if you inherited $10 billion, now you have a really big money problem. But when any of us come into the world, and for most people listening to this podcast, when you join the military, you start off with this money problem, and for most people, that money problem is I don't have any, or I have a negative amount of money, and
Yeah.
that was my problem when my wife and I got married. We were both collectively worth negative amounts of money because of our student loan debts, and and that's similar to your story too. But what we're talking about here is we're talking about solving the money problem of life, but there's so many other problems that you need to solve in life. And just solving the money problem, I mean, that's good, and that's something that you need to do, especially if you want to be financially independent, obviously. But also building in flexibility to your plan is going to allow you to solve a lot of the other problems that you're going to have in life. And so yeah, I really like how Morgan talks about the idea of being reasonable, if not completely rational. And he talks about how it's so important for people to recognize that you don't need to get it 100% right. Even getting it 80% or 50% right is enough to get you to FI. That wasn't a quote. That was just me talking in like a quote voice. But he does talk about um, one of his deeply held investing beliefs is that there's little correlation between investing effort and investment results. And that's something that I have found to be true so many times. In fact, the more I research an investment and the more that I spend trying to understand an investment, it seems the worse I do. And I think crypto is like one of the best examples. I mean, like I first heard about Bitcoin in 2010, maybe it was. I was going to school, Boston University, right across the river from MIT. Like I knew guys who were like in the cryptocurrency scene very early on.
Really.
And when they first explained it to me, I was like, I don't get it. Like, what's the point of this? Sounds cool, but no thanks. And again, like I turned it down, when it was $1, when it was $10, when it was $100, when it was $1,000. And every single time I'm like, it's not the game I want to play. It's not. And so I've turned it down every time, but I did understand what my plan was. And my plan has always been, passive index fund investing, dollar cost average in over many years, and it's worked. I've executed it through several downturns, and right now we're in one of the worst downturns. In fact, I listened to a podcast the other day, and it was the worst 6-month period of the U.S. stock market plus bonds. So bonds and U.S. stocks combined, it was the worst 6-month period in the financial markets. But guess what? Like, my portfolio is still there. I haven't gone back.
Yep.
I haven't gone to zero. It's a lot lower than it was a couple months ago, but it hasn't gone to zero.
One of the quotes I think we've said before is I can afford to not be the greatest investor in the world, but I can't afford to be a bad one. And I think that kind of summarizes the mindset there of the passive index fund investing of, it's okay if I don't make 40x gains in the recovery. I'm going to make good enough. I'm going to average with the stock market. And if I beat it by a percent or two, great. But if I am right with it, then that's fine too. So a lot of people just are out there chasing to have an amazing return on their investments instead of just an okay, an average one, which is a lot easier. Going back to your point, Spencer, about financial problems and how a lot of the stuff we talk about is finances. I think it is important to remember though that this is not in the book. This is Jamie's personal opinion. A lot of the financial stuff does affect life in other ways, marriage, job, relationships, and things like that. I just did a quick Google search, like top reasons for divorce in the United States, and financial disagreements was number 2 on there.
Yep.
So there's definitely ways that these financial conversations can impact all of your life, especially your relationships with your significant other, with your kids, with your parents, and your coworkers. Because like if you're stuck in a dead end job because you can't afford to quit, then that's gonna affect your happiness and your joy in life, which is going to affect everything. So, what's reasonable to you may not be ideal at the moment, but hopefully as you have savings and then the other point I wanted to get back to just real quickly was the mortgage freedom and having a paid off house. Sure, it doesn't make sense on the spreadsheet, but imagine if, say, your monthly mortgage payment is about 20 to 25% um, of your budget each month. It's probably more like 20 to 30%. I bet most people don't keep it below 25%. That's what I think that's the percentage that Dave Ramsey recommends. So most people are probably well above that. Say it's 30%. If you get rid of your mortgage, imagine having 30% of your budget freed up and then what that could do to your savings rate. So there's a lot of potential there as well. That is not just you make a temporary hit on the investment, sure, and a little bit of lost opportunity cost. But I'm a big fan of that concept. And if I didn't have to move again, I would try to pay for my house for sure instead of renting.
Yeah. Yeah. I think it's a little, that example doesn't work as well for military folks just because we're moving, on the officer side, it starts to be, as you get later in your career, it's like every year or two. And then on the enlisted side, usually it's like every 3 to 5 years. So depending on your branch and everything. But yeah, I think it's definitely when you do get to the point where you have a home, I think, paying it off quickly or just paying cash for it is,
Yeah.
again, it might not be rational, might not make sense on the spreadsheet, but it's definitely reasonable.
Yeah, think about the safety of margin that it would provide of no matter what happens to you or to your job, that your family has a place to live. And as you
Yeah.
age, like I have a relative who is older and um like what are they going to do when they get older and aren't working anymore? So if they had a paid off house, they would have a lot less grief, anxiety, and stress about aging because no matter what, they would have a place to live. So anyway, that's kind of a Jamie rant, but
Yeah. No, it's so true though. Yeah, because I mean, then that's the thing, right? Is for most people, you're not going to work your entire life. And now, if you earn a military pension or a pension from another company, or you have sufficient savings, then you might have income your entire life, and then Social Security kicks in your 60s as well. But it is very liberating if you get to the point where you're not working anymore and you don't have a mortgage payment anymore. I think that can be extremely, like just like you said, it builds margin of safety in there and allows you to run an unbreakable financial house. A couple other things that he talks about and kind of the reasonable plan is there's an old pilot quip that their jobs are hours and hours of boredom punctuated by moments of sheer terror. It's the same in investing. Your success as an investor will be determined by how you respond to punctuated moments of terror, not the years spent on cruise control. I would say that should probably be autopilot there, not cruise control. I'll uh, I'll forgive him. He doesn't sound like he's a pilot himself. Um, but and I think that's a great quote there, and because I'm pretty sure he wrote this book before the COVID crash too. And I have to go and check because I remember that was the 20% drop that we've had in 2022 is kind of taken a few months, but the COVID crash was like quick. It was rapid. I mean, you could check the market
Mhm.
every day and be like, oh, great, I just lost another $10,000 or no, I'm down another 6%. And there were times on the way down where I was thinking, oh, like, should I just stop the bleeding? Should I just go like move some of it to cash, wait for it to drop another 10% and then go back in, right? But if I had done that, and I'm so glad I didn't do that, I probably would have mistimed it completely because the day it started going back up, which was like March 20th, I think, and it was like right in the middle of our 14 days to flatten the curve, and travel was locked down. Warren Buffett had just dumped all his airline stocks. I mean, it was madness. Like you couldn't find toilet paper anywhere. We were trying to make masks out of like socks, and it was insane. And I don't think I would have had the intestinal fortitude to move back into the market at that point. But what I didn't do was sell. And that was my moments of sheer terror there, because we were at an all-time market high just before the COVID crash, as it almost always inevitably is. The market is always hitting all-time market highs. And so my portfolio was at its all-time high. And to watch it go from all these years of savings basically just completely reverse themselves. And I went back, to the amount of money I had in 2015, right? Or 2016. I can't remember what the exact year was, but it was painful because it was like, man, all that money I just threw into the market over the last, 4 or 5 years has basically evaporated. But it hadn't evaporated, right? I still own the shares. They were still there. And I had a plan and I stuck with it. And I think that's the biggest takeaway right there is have a plan that you can stick with during the moments of sheer terror. And if you don't have that kind of plan, go to the bogleheads.org, go to my website, look up my asset allocation, read my book, there's tons of books out there on how to like build a reasonable portfolio. But basically just like stocks and bond index funds, mix them together and you'll be fine. And you'll be fine. And if you're in the TSP, go listen to our TSP episode because we've got a whole bunch of different portfolios that you could build in the TSP. And we don't know which one's going to be the best because we don't know the future. And that's kind of the fun part of it, and also the terrifying part of it.
He talks, Spencer, in the book about bull markets, bear markets, and having FOMO, or fear of missing out. If some of our listeners haven't heard that term, how can we apply some of the principles and the psychology side of money to the current stock market drops that we're seeing here in the middle of 2022?
During the bull market, it was it was funny coming to work, and everybody at work, it seemed like everybody at work was on Robinhood, was day trading, was buying Tesla at $200, and a couple of weeks later it was at $400, and they were buying more. Right? They're gonna what was the phrase? We're gonna take it to the moon. We're gonna ride it to the moon.
Yeah.
Yeah, AMC and all GME, and it's your classic bubble. I mean, it happens all the time in economics, whether it's the Dutch tulip bulbs back in the 1600s. In the book, he talks about Cisco stock. And I remember this when I was a kid, 1999, not the exact details, but 1999, Cisco stock rose 300% to $60 a share. And it was valued at $600 billion, which at the time was insane. And there was an economist who pointed out that the implied growth rate of the stock meant that it would be larger than the entire U.S. economy within 20 years. And so if you think about like that's insane, right? Like you can't have a company outgrow the entire US economy in 20 years. And that's what a lot of people were saying about Tesla as it was like just, skyrocketing up and up and up is, oh, it's a new economy. This time is different, right? You always hear like this time is different, but it's usually not. Bubbles and bull markets, they do their damage when long-term investors, he says, bubbles do their damage when long-term investors playing one game start taking their cues from those short-term traders playing another. He has this other line. So you may have looked around and said to yourself, wow, maybe these other investors know something I don't, end quote. And I think there was a lot of that with like why I bought crypto or a little bit of crypto earlier in the year and last year was there's a lot of smart people, seemingly smart people, who were involved in it, right? And a lot of them are pretty smart, but at the end of the day, like I didn't know any different. And maybe in the long run, like they'll be proven right? Maybe like one day Bitcoin will replace the US dollar. But in the short run, like it doesn't really matter. Like if you're buying US stocks and all of a sudden we switch from using, US dollars to Bitcoin, like Apple will still sell you an iPhone, right? They're still producing a product. They don't care what they sell it to you in, whether it's in Japanese yen or euros or US dollars or Bitcoin, right? Like they'll still sell you the iPhone. And if you own a little bit of the company, you're going to be okay. Even if no matter what currency it's priced in, as long as you recognize that and you can keep your FOMO down to a minimum. And I think, for me personally, there was some of that going into the decision to buy a little bit of crypto was, hey, I don't want to miss out. Like if this is the next thing, I don't want to be left on the outside. And then sure enough, the bubble pops and it falls 70% within a couple months. But one other thing he talks about is in investing, to be successful, you have to pay a price, right? To buy anything of value, you have to pay for it. But what's interesting about investing is it's not dollars and cents that you're paying, it's volatility. And so his quote says, quote, like everything else worthwhile, successful investing demands a price, but its currency is not dollars and cents. It's volatility, fear, doubt, uncertainty, and regret, all of which are easy to overlook until you're dealing with them in real time. And so to me, that quote right there, he has another line where he talks about consider volatility to be the fee of successful investing. Don't think of it as a fine. Like, don't think of it as something to avoid. There's this concept in behavioral economics where you have fees and fines. So if people think, and the classic example is they weren't picking up their kids from preschool at the right time, and so they said, okay, so from now on, there's a fee of $50 an hour if you don't pick up your kids on time. And what happened? People started picking up their kids even later because they were like, oh great, I just have to pay for it, and then I don't have to go pick them up. And so they were treating it like a fee when the preschool was thinking of it, oh, it's like a fine to punish people. And it's the same thing with like parking tickets, right? Like if it's $10 to park at the meter but $20 to get a parking ticket, some people will just take the parking ticket because they consider it the fee of parking, not the fine of doing something wrong. And so in investing, it's definitely, volatility is definitely the fee that you pay. And so when you're a long-term passive index fund investor and you're not doing anything because it's not part of your long-term strategy to change during a bear market, and you're watching, tens of thousands or hundreds of thousands of dollars of losses, and you're like, shoot, what am I doing wrong? Well, you're not doing anything wrong. You're just paying the fee. And the fee is some years, some months, maybe even, longer. Like if you look at the Japanese stock market, some decades, you're going to be down, and you're going to think, man, maybe I should get into active funds. Maybe I should get into something else. But that's when you have to go and reevaluate your first principles. And if you got it wrong the first time and you decide, you know what? Maybe putting all my money into Bitcoin exchanges wasn't the right idea because now I don't have any money because they've frozen it all and they've lost it all. Then yeah, go back and reevaluate your first principles. But if your first principles are sound and you understand that sometimes stocks are down and sometimes bonds don't pay as much as you'd like them to, and that's part of your plan, then that's good. Stick with it.
All right, Spencer, I think we have fully hooked people on the line that they need to go read the full book, but I think we gave them enough to get some big takeaways out of the book if they haven't. I'm going to close my contributions to the podcast, and then I'll pass it back over to you for your kind of last point or and main takeaways. I think the one quote that kind of summarizes my favorite concept of this book is, think of it like this. He says, one of the most powerful ways to increase your savings isn't to raise your income, it's to raise your humility. People with enduring financial success, personal finance success, not necessarily those with high incomes, tend to have a propensity to not give a damn what others think about them. So I think that is a great summary of the way that this book just flips personal finance over, and the way we've all looked at it in spreadsheets and calculators. And then we've even talked about, we had a whole episode of what our favorite calculators were. And this book just really flips that over of the mindset shift and the psychology that goes behind it of, if your goal is to have extra money and more savings to show off to people, then you're never going to achieve that. There's always going to be someone wealthier than you. Everyone's always going to have someone else that they're trying to catch up to, someone else with a better job, someone else with a nicer car, someone else with a nicer house or whatever. The only way to increase your savings, he says, isn't to raise your income, it's to raise your humility. And so I will leave that with the listeners today and pass it back to you for closing.
Yeah, I like that. Anytime a book tells me to raise my humility, that's it's probably going to be one of my favorite books. I My last point I want to leave the listener with is the craziness of compounding interest. And he talks a lot about Warren Buffett in the book. At the time that he wrote it, Warren Buffett's net worth was about 85 billion. And I just looked it up. I think it's 95 billion today in 2022.
Wow.
And that's with the stock market being down 20%. But so he says, as I write this, quote, as I write this, Warren Buffett's net worth is 84.5 billion. Of that, 84.2 billion was accumulated after his 50th birthday. 81 billion came after he qualified for Social Security's in his mid 60s. So it's just absurd if you like 99%, more than 99% of Warren Buffett's net worth came after he turned 50 years old. And it says a lot about being a smart guy and being a clever investor, but he's not the greatest investor of all time, other than he's been investing the longest. And the power of compounding interest is absolutely absurd. One of the main reasons that we know his name is that he's been investing for such a long time. He's been since his 50th birthday. I think he's like 89 now or something. And let's see, Warren Buffett, age 91. Okay, so he's been investing for 41
Wow.
years since his 50th birthday. So if you think about that kind of timeline, that time frame, the decisions that you make today might be impacting a 91-year-old in the future. And so for me, I mean, what would that be? Let's see, 57 years. So that's pretty, 57 years of compounding returns. That could turn my little net worth into quite a bit of coin. All right, listeners, thanks for hanging out with us today. Psychology of Money, Morgan Housel. You can find it on Amazon. I also have it on my website, and the address is militarymoneymanual.com. You can read another review I have on there. I think the article is called Financial Independence Books. If you just search that, you should be able to find it on my website. 3 main takeaways for the military listener today. Save money for no reason at all. Just save money. Build a margin of safety into your financial life. Save money buys you freedom. Number 2, play your own game. No one is crazy, but people do stupid things with their money. So make sure you know what game you're playing, stick to it. If you want to go dabble in some other games, that's fine, but do it in such a way that you won't get wiped out. And finally, number 3, don't just do something, stand there. Usually the correct move with any investing, whether it's during a bull or a bear market, is just to stick to your guns, stick to your plan, be reasonable. Don't worry too much about being rational, but don't change your strategy, especially if it's a long-term passive index fund strategy. If you're thinking, what am I doing? I'm down 20% this year. It's okay. It's built into the system. You're going to be fine. As always, if you have any questions or feedback, you can message us on Instagram. I've got a lot of great messages recently. It's at Military Money Manual. I also have a Twitter now. I guess this is the first time I'm revealing that publicly. I don't check it that often, so it's mostly just to promote the book, but it's at Mil Money Manual, MIL Money Manual, or just search Military Money Manual. It should pop up on Twitter. Email info@militarymoneymanual.com. We appreciate all of you for joining us today. We're grateful for all of you. Keep sharing the podcast with your friends, your coworkers, your relatives that can stand listening to us. And we'll catch you on the next episode of the Military Money Manual podcast.
Thanks so much for tuning in to this episode of the Military Money Manual podcast. If you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This helps others find the show, and we really appreciate it. Thanks again for tuning in, and we'll catch you in the next episode.
Hey guys and gals, Spencer here again. Before I let you go, I want to let you know about 2 things. First, my 100% free course. It's called the Ultimate Military Credit Cards course, and you can sign up today at militarymoneymanual.com/UMC3. I've been running this course for over 4 years now, and we just celebrated our 7,000th graduate. In this course, I walk you through an absolute beginner's guide to travel hacking and opening your first fee-waived credit cards in the military. Again, you can sign up today at militarymoneymanual.com/UMC3. It's 100% free, no spam, and you can unsubscribe at any time. Second, my book, The Military Money Manual, A Practical Guide to Financial Freedom, is available on my website and Amazon today. Head over to shop.militarymoneymanual.com, or if you want the Amazon version, search Military Money Manual. This is the book I wish someone had handed me on my first day in the military. In this book, I cover the exact money tactics and investment strategies I used on my path to achieve financial independence while I served in the U.S. Air Force. The book is the best personal finance book specifically for you, whether you're an active duty, guard, reserve, a military spouse, enlisted, or officer. Any ROTC or Academy cadet can benefit from the tactical and strategic advice I lay out in the book. But don't just take my word for it. Here's 2 reviews of the book. Ryan on Goodreads.com wrote, "The most comprehensive investing personal finance book specifically written for military members I've read so far. This book should be handed to every new LT at commissioning." Matt on Amazon said, "This book is incredibly straightforward, easy to understand, practical, and useful. This book should be on the Commandant's reading list." Thanks, Matt. If you're interested in the book, head over to my website, shop.militarymoneymanual.com, and podcast listeners can use promo code PODCAST to get a special discount on the ebook, audiobook, and hardcover book. You can find the audiobook on Audible, the ebook on Amazon Kindle, and the hardcover book on Amazon, or again, head over to my website and use promo code PODCAST for a special discount. Thanks for listening.